The housing market is in serious trouble, and the Florida housing market is no exception. So, today we're going to do a deep dive into the data that exists in Boca Raton so that you have all the information, the most actionable information, in order to make the best decisions for yourself, for your family, and for your financial bottom line. If you're new to the channel, welcome aboard. My name is Chris Igo. If you're a returning viewer, I appreciate your participation in our journey. And if you find this content valuable, please subscribe. It means the world to me. Give it a thumbs up, leave a comment down below. The engagement helps the algorithm exponentially, and it organically extends the reach of this channel to be able to connect with people just like you. And I want to serve and support everyone at the highest level possible. But enough sales pitch, let's get into it right now because the housing market is in serious trouble and we must address the big elephant in the room. And the big elephant seems to be ignored by most people when talking about the housing market. In fact, almost every analyst, almost every real estate professional that I talk to wants to tell me how now is completely different than 2008. And every single time I challenge that assertion, I typically get a lot of pushback. And I'm typically told how lending standards have changed radically, and there's zero possibility that we could ever revisit a 2008 crash. And to be clear, every market is going to trade differently. So what's happening in my hyperlocal market and what's happening in Boca Raton is very unlikely to be what's happening in your regional or local or hyperlocal market. And I'm fully aware that the lending standards have changed. And I'm also aware that most homeowners are sitting on a tremendous amount of equity, which gives them comfort and makes them feel wealthy. And I too can make the argument that the fundamentals of many aspects of the housing market and the lending market are radically different than 2008. But what very few seem to be talking about is the fundamentals of the consumer have changed radically, and the fundamentals of the economy have changed radically. And so, yes, I agree that today is definitely not 2008. In some ways, it's significantly worse in others. But to be totally transparent, I am not an economist. I'm certainly not an analyst. I'm not a statistician, and I'm not a fortune teller. Although, full disclosure, I do enjoy an occasional fortune cookie. But I do know that a lot has changed. I do know that fear is on the uptick. And I do know that the cost of capital for many big companies has become overbearing and unsustainable and going to lead to mass layoffs. And we've already seen that in many places. And I predicted all of this a year ago. So be sure to check out my liquidity crisis video, which I will link up above, because all of the things that I talked about then have happened and are happening right now. And full disclosure, it's not because I'm so smart, it's because I've experienced all of these things before. I've lived through all of these types of events. And full disclosure, what we're going through is unprecedented. We've never experienced all of the things that are happening today previously. And yes, I was a financial professional. I was a stockbroker, and I made my clients and myself a fortune during the great financial crisis. I suspect what we saw during the great financial crisis is going to feel like a cakewalk relative to what is likely to happen in the future. But that is going to take time. And we're very early in the process. We haven't really even started to feel the real pain of recession. But make no mistake, it's coming. But let's see what the analysts have to say.
To go up. But we're very, very far from 2008. We're all trying to draw parallels to something in the past, and '08 really isn't it. We have to look at an environment where really credit has become a little less available, but it's not entirely curtailed. And the price of it has increased, but not dramatically enough that it's going to create a tsunami of problems.
The rising cost of capital is not going to create a tsunami of problems. Huh. That's not true. We only have to remember last week or 2 weeks ago when banks started to fail, when banks realized that they're not capitalized the right way. And it was also exposed that secured deposits, insured deposits, are really not insured or secured because the FDIC's got $128 billion of cash earmarked to insure over $3 trillion worth of insured deposits. 1.3% of deposits that are supposed to be insured actually have cash to insure it, unless there is more money printing. And to be clear, there isn't actual money printing. There are no printers that are printing money right now, but there will be some funny accounting that happens and the balance sheet will change. And if you don't believe me, go check the money supply, because the money supply has increased exponentially over the last month. And Jerome Powell has said that he's going to continue to increase interest rates, specifically Fed funds rates, and he has continued to do so, and he will continue to do so. He's told us exactly what he intends to do. Yet the Treasury is doing something different. And they can sugarcoat it however they want, but at the end of the day, whether you want to call it quantitative easing or bailout or tightening or whatever name you want to give it, just go look at the money supply to see how much it's increased.
Here, from a refinancing perspective, you have to look at what were property values 5 years ago.
And to be clear, right now he's talking about commercial real estate. And if you've been watching for a while, you know I've talked about that space. You know that there are massive defaults that are happening right now in the commercial space sector. And there will continue to be defaults that happen in the commercial real estate sector. I'm primarily concerned about residential real estate, and he's going to go on and talk about that now.
So it's really a question of choosing the sector. And a lot of people will say, well, retail, for instance, has to be a sector where a lot of challenges could come up, but it has declined so much in value in the last few years, and the pain has been passed so much in terms of operating fundamentals as well. The sector like retail is potentially going to do better versus other sectors, the mainstays like office and residential, for instance, that are still not fully either pricing in the pain or fully seeing the changes in the operating environment.
And to be fully transparent, he's talking about the European markets. And for the most part, he's not talking about residential real estate. But what he did say, which I want to key in on, I want to hone in on, because I think it's the most important thing that he said. He mentioned the fundamentals of the market. And the fundamentals are exactly the thing that nobody seems to be talking about the right way, because the fundamentals of the lending and the housing market are two separate issues. And obviously, they're very correlated, but let's put them in their own bucket for now. And let's talk about the next bucket that nobody seems to really be keying in on, which is the bucket of the consumer fundamentals. And let's role play this a little bit here. And let's pretend that all of the people who say that this market is completely different than 2008, let's just say they're right. And let's say that the sell off that we've had in the housing market really is the bottom, which I don't agree with, but let's just pretend for the sake of this argument that that's true, because the US housing market has lost something close to $2.4 trillion over the near term. So let's pretend the bottom is in and this is not a dead cat bounce. And let's pretend that the fundamentals of both housing and lending are great. They're muy bueno, which again, I don't agree. But for the sake of this argument, humor me. The consumer is no bueno. The consumer is financially challenged. And we are at the beginning of those financial challenges, because most folks who own real estate are sitting on a lot of equity. And Florida homeowners are sitting on a metric shit ton of equity at much lower mortgage interest rate. But as big corporations lose access to capital, they lay off workers. They lay off employees. They cut the pinky to save the arm and they trim the fat to restore profitability. And we've already seen layoffs starting to happen. And it's going to continue to happen at a much higher rate as the pain of recession increases and the access to capital decreases. But we're in the early stages of that happening. We're in the first inning. But as we march forward into the future, the fundamentals of the consumer get worse. And so the fundamentals of the housing and lending market might be impeccable, which again, I don't agree with, but the fundamentals of the consumer are deteriorating fast. And as the everything bubble continues to burst, as stock market values continue to fall, as other financial markets deteriorate, the fundamentals of the consumer gets worse. As inflation increases, the fundamentals of the consumer gets worse. As the labor market tightens, the fundamentals of the consumer get worse. As the cost of living skyrockets, the fundamentals of the consumer gets worse. And uncertainty and fear grow exponentially every time the fundamentals of the consumer gets worse. And I don't have to be Nostradamus to understand that the fundamentals of housing and lending can be perfect. But if the consumer is shook and afraid of losing their job, and their net worth on paper has been cut by 30, 40, 50%, and they stop buying and start saving or start hoarding cash, the fundamentals of the housing market and lending market and economy go right down the drain. And it doesn't happen overnight, it takes time. But make no mistake, the housing market is in serious trouble. Which brings me to the most recent data that exists for Boca Raton. And to be clear, we're at the end of March. These are February numbers, but Boca Raton is not feeling any type of recession. In fact, there is no housing recession in Boca Raton. And I've made the argument that there are certain markets that are more insulated than others. Boca Raton happens to be one of them. Up until it's not. But you need to know exactly what's happening right now in order to make the best decisions for yourself, for your family, and for your financial bottom line. I'm talking about single family homes in Boca Raton, and this is the 5,000-foot overview of Boca. The hyperlocal markets that trade within it will trade very differently. Closed sales are down 26%. Median sales price up 14%. Massive jump from 730 to 832 and change. And the average sales price in Boca also skyrocketed, up 11.2%. And if you've been watching for a while, you know that I've talked about a return to normal in terms of appreciation of homes. And I've called for single digit growth for the rest of the year. Well, Boca Raton's an outlier. And in February, we had double digit growth in both median and average sales price. The average sales price for a home in 2023 in February was just over $1.5 million. But the percentage of original list price received is down to 90%, which is down 8.2% from 98.1%. Gone are the days of it being a layup to get 100% of original list price received. Unless you work with someone who knows how to create a market within a market, which will create a bidding war and get multiple competing offers, which bid the price higher, finding you the one buyer on planet Earth willing to pay more than anybody else. But not everybody knows how to do that. Time to contract up 90% from 31 days to almost 60. Pending sales down 8.5%. New listings down 23%. Inventory of homes for sale, which is your competition if you're thinking about selling, and it's your choices if you're thinking about buying. It upticked almost 86%. But to be clear, relative to 2008, 2009, 2010, relative to when the housing apocalypse was happening, there's a massive undersupply of homes for sale. And although the month supply of inventory upticked by almost 160% to 3.6 months, during the last crash, there was something close to 30 months of inventory. To put that in perspective, we've got 3.6 months of inventory in February for Boca. It was 36 months back during the last crash. Years, not months. Years, which absolutely does not mean that half-price homes are coming to Boca anytime soon. But the rapidly deteriorating fundamentals of the consumer tell me that the housing market is in serious trouble. Now, I hope you found this content valuable, and if you did, please give it a thumbs up, subscribe to the channel, share it with a friend, and check out my next video because I suspect you will love it a lot. And until next time,